Hey everyone, George here. So if you're a contractor using a personal truck or vehicle for work and your company, your business reimburses you mileage, there's a tax rule that almost nobody talks about. And it could potentially get you a pretty good deduction. It doesn't show up when you file each year, but it shows up years later when you sell or trade in that truck. On how it's handled, you could either miss a massive deduction or accidentally report it wrong. In this episode, I'm going to show you how exactly this works. So without further ado, let's get started. So who does this all apply to? Construction business owners, foremen and superintendents, project managers, owners, basically anyone in construction who drives their own truck, gets mileage reimbursement and replaces their vehicle every few years. So here's the common misconception, what everybody assumes. So people think the company reimburses them mileage, so the truck is completely 100% personal and therefore tax neutral, but that assumption is actually wrong. The IRS says that if you reimburse for mileage, that truck has a business use component for tax purposes. Even if it's titled in your name, you never depreciated it directly, and the reimbursements weren't taxable income. Technically, you're still supposed to track depreciation. So the standard mileage rate isn't supposed to just cover you for oil and gas. Inside that rate is depreciation per mile. Every year, the IRS assigns the depreciation amount, 28, 30, 33 cents per mile, depending on the tax year. That depreciation reduces your truck's tax basis, even though you never claim depreciation on your return. So this is where the surprise comes in later. So let's walk through one real-life example. Let's say a contractor buys a truck for $85,000 and uses it strictly for work, job sites, suppliers, inspections, client meetings. And let's say over 4 years, he racks up roughly 50,000 business miles. And let's say his business reimburses every mile at the IRS rate. So those miles quietly generated 14,800 of deemed depreciation. So later when he trades in the truck for say $47,000, so we have original cost of $85,000, adjusted tax basis of $70,000, trade-in value of $47,000. So that's a $23,000 loss for tax purposes. So this isn't even a capital loss. This is a Section 1231 loss, meaning it's an ordinary loss that's fully deductible and not capped like capital losses. So that's a huge difference. So for a contractor in a higher tax bracket, that loss can actually give meaningful deductibility and tax benefit. And the biggest problem is most people assume that if they reimburse themselves the IRS mileage, have an asset on the books. That's not entirely true. And again, it doesn't even need to be titled or insured to the business name. It could be to you personally. If you reimburse yourself mileage, that technically is still a business asset to an extent, and you might be losing this loss that you could report for tax purposes and get a tax benefit. So this is where people get stuck. They think mileage reimbursement makes you whole for operating costs, the depreciation as you go, but it doesn't guarantee you recover the full purchase price or the remaining tax basis. The IRS treats those as two separate things. On one hand, you have the ongoing reimbursement, and on the other hand, you have the final disposition of the asset. The numbers don't match, the tax code allows for the loss to be taken. So why do a lot of contractors miss out on this? They may be missing out because trade-ins feel pretty routine, CPAs assume it's personal, and nobody asks about mileage history. And many returns I've seen coming from prior CPAs don't even include the Form 4797 upon sale of the asset. So what should you do going forward? So if you're in construction, you should definitely keep a mileage log, track purchase price, track trade-in values, and let your CPA know that the vehicle mileage was reimbursed. And ask the one simple question, was the Form 4797 filed for my trade-in? If the answer is no, then you might have missed out on this loss. So this isn't new. The IRS has historically been pretty clear about it, but most contractors never hear about it until it's too late. So if any of this applies to you or you have any questions, our calendar link is down in the show notes. Feel free to book a time. I hope you found this helpful, and see you in the next.